All right. Might just wait a couple of minutes.
I'm still like,
Oh, I know.
it's now in my brain now. So we kind of need to get into this or get it out of our brain.
I know, it's not the best start. I was like, oh, should I just get in early? All right. Won't wait too long. I'll give it one more minute and then we'll jump in. How's everyone doing? Freezing.
Yes.
It's cold.
All right. I might kick it. Oh, we lost the end.
Yeah, no,
I'll wait till the head comes back and then we'll start. Oh,
Right here.
Right. Okay. We might just get going. All right. So hi, everyone. Thanks for joining the High Growth Ventures Q&A session. For those of you I don't know, my name is Amanda Price. I'm the head of High Growth Ventures, which is a team dedicated to working with startups within KPMG. We launched in 2017, I think it is, and over the last few years, we've developed a range of startup specific services designed to help founders build sustainable and scalable businesses. Before we start the session, I'd like to acknowledge the traditional owners of the land on which we meet today, the Gadigal people of the Eora Nation, and pay my respects to elders past and present. I only have one housekeeping thing, which is great, which is that we are recording the session. The other thing I will say is that we do want to keep it really interactive. So if you've got questions, just post them on the chat. So I've got it open and I'll try and get to them and weave them in as best as I can. So the topic for today is balancing act, how to grow efficiently and carve a pathway to profitability. Over the last 12 months, we've seen a huge shift with investors changing their focus from high growth to profitability. It seems the million-dollar question that all investors are now asking early stage tech startups is there a clear path to profitability in your growth plan? But shifting a focus on profit doesn't mean to investors that they want the business to stop growing. Instead, they want it to grow more sustainably while generating profit. And that's what we're going to discuss today with our very experienced panel. I'm going to hand over to them to introduce themselves. And what I'll do is I'll nominate you. And then when you're finished your introduction, Rajiv, you nominate the next person till we go around, comes back to me. So Rajiv, we'll kick off with you.
Thanks, Amanda, and thanks to the team at KPMG High Growth Digital Ventures for hosting this call. I'm Rajiv Gupta from Allium Capital. We're a crossover fund. We do both public and private investments, private investing all the way from early stage to all the way that is late stage, even public. We currently manage around $500 million. We've made 108 investments since inception. We've had about 25 companies that have gone public and 18 companies have been acquired through M&A. Technology is our focus. We will support anyone that is from Australia and New Zealand, located anywhere in the world. Jerry?
Thank you, and thanks to the KPMG team for hosting us today. My name's Jerry Stessel. I'm a partner at OAF Ventures. We're an early stage venture capital firm focused in sort of at the early stage, seed to Series A. We also manage around $500 million. What does seed to Series A mean for us? It's sort of early revenues, a couple $100,000 in revenues, right through to a couple $1 million of revenue. And check size for us is a couple $100,000 through to $5 million sort of first check. We're on a relatively concentrated portfolio, so in any one fund, it's sort of 12 to 15 companies. We're now investing out of our third fund, which we raised 6 months ago. Yeah, that's a bit about us. Daniel.
Awesome. Hello, Daniel. I'm the founder and managing director of Icaros. We are a growth consultancy, so primarily focused around product-led growth and growth foundations, so effectively processes, systems, data. We work a lot with kind of like Series A plus scale-ups and SMEs, primarily private equity-owned SMEs.
I think that leaves you, Leanne.
Yes.
That's okay. Thank you, team. Hi to everybody on the call today. I'm Leanne Hegarty, our partner here at KPMG. I lead our outsourced CFO and finance function support business. In that business, as I say, we make spaghetti look tense in terms of the flexibility that we offer to founders. So what I mean by that is we do everything right from doing your payroll, doing your AP, up to acting as your finance manager, controller, director, and even your outsourced CFO. We take on your entire finance function, or we blend with existing functions. But as I said, our role is to support you and help you achieve your goals. And one of those things that we do, particularly with founders, is we help to educate you along that curve. Not only you know your product, but we help you learn about your business and how to have those conversations with the likes of the gentleman on the call today.
Excellent. Okay, we might jump into it. So I'm going to start with a quote and sort of point to Rajiv and Jerry at the beginning to sort of address this. But the quote is, I don't know where the quote's from, but anyway, for the tech founder in 2023, profitability is now more than a long-term goal, but instead a key expectation investors are looking for when deciding whether to invest in your business. Rajiv, is that true, and how focused are you on profitability?
Profitability for us has always been important, which is why we probably haven't been as active investing as some of our peers. So to give people a sense, a third of our portfolio was profitable going into COVID, and today 50% is profitable. So we're always looking for businesses that are profitable, and I think it's just escalated and elevated across the entire ecosystem, whereby not only investors talk about it, investors into investment funds are very focused on it as well, and therefore it trickles down. Ultimately, business is about how you get a return, and you get a return through a dividend or capital growth, and both of those outcomes require profitability. So Amanda, for us, we have always been focused on, and I encourage everyone on the call to think about it hard, revenue of conversion to gross margin to operating profit. You've got to make sure you're constantly thinking about it. So every dollar spent, what the impact of that is below GP as an example. So it's highly elevated, and I think it becomes entrenched as a metric going forward.
And I think
You're on mute.
I'm on mute. Am I still on mute?
Off now.
Not now. Oh, sorry, Jerry.
Yeah, I 100% agree with Rajiv. I think probably the only thing I'd add is it is stage dependent. So I think, at the early stage, we've always been very focused on profitable unit economics. I think at that early stage, it's hard to be profitable on a cash basis or on a P&L basis, because you need to invest in R&D, you need to build the assets, sort of a property development. You need to dig the hole, you need to build the foundation, you need to build the building out of the ground. It's only once that happens at the back end, is it profitable? So I think it is stage dependent. At the early stage, unit economics and how profitable you are on a unit basis. What's your LTV to your CAC, for example? And I know we'll talk more about some of the metrics later. But that's probably even more elevated now, versus growth at all costs and just throwing money at a wall and hoping it sticks. But definitely as you mature and you sort of approach that growth stage where Rajiv focuses more, you need to be showing a very clear path to profitability, if not being profitable already.
Amanda, one of the things that we observed, and Jerry and the rest of the team no doubt see this as well, is some very early stage companies were raising in the last 2 years, and the focus was growth at all costs and going global very quickly. And I think that has changed significantly. So now the focus is about the team, it's about your technology and how much of it's insourced, it's about efficient financials and that path to profitability over time. But I concur with Jerry, very stage dependent.
Yeah, stage. And what about industry dependent? So how do you see that across the industries? Because obviously it's very different from a med tech to a SaaS to a climate tech type company.
I think it depends a little bit less about industry, more about business model. So for example, a marketplace model, you might need to invest heavily upfront to build liquidity on the supply side, on the demand side, sort of win that marketplace. And so in that scenario, I think investors are more, for example, one of our companies, Go One, it's a corporate learning platform. It's a marketplace. On one side, they have content, on the other side, it's sort of distribution through learning management systems. At the very first board meeting after we invested, I remember the founders presented a case on why they need to raise $300 million over the next 3 years. This was just after their Series A. And the reason was they believe they're in a winner-take-most market, and once you sort of capture the market, both the supply side, demand side, you're in a strong position. And they showed case studies of where sort of domain versus realestate.com, and the number one player and the number two player, and the drastic difference in profitability. And so I think it depended on business model, where there might be a period where you're actually accelerating burn to capture that marketplace, but then, you know, the expectation is you turn into a very profitable business. So that's probably what I'd say. I think it's less dependent if you're in climate tech or cyber or ag tech, etc. Obviously, hardware and software are different, but yeah, I think that's one of the differences where there might be some more appetite for, you know, burn for potentially a little longer to capture a sort of a marketplace.
Yeah,
And there are some businesses, Amanda, to add, you know, the ones that rely on resellers. If you rely on a reseller, your gross margin will always be a lot lower because you're giving it away and you don't have the pricing power that you want. So businesses that have business models where there is pricing power and high gross margins, they should be more expensive. They deserve a higher valuation. And then it's about efficiency and growth.
Yeah. Yeah. And Jerry, like with Go One, given you thought that argument was compelling then, do you think that you'd still think it was compelling now? Do you actually think that they would get that funding, or would it be just not on the table to even, you know, go and ask, sort of talk about that vision of having 300 million over X years?
I think it's definitely harder to pull it off now. Thankfully, they have sort of gone and executed and sort of raised that capital and has built a strong position in their marketplace. But I think today to turn up at a board meeting and show an accelerating burn profile that's increasing month on month, I think's a harder argument to win around the board table today.
Yeah.
I think there's just less risk appetite. I wouldn't say risk appetite, it's more the price on growth. So yeah.
Yeah. And so with it'd be good just to delve into this. So with like, what impact is the shift to profitability having on the way that you evaluate, like VCs evaluate these businesses, and sort of how does that impact founders and how they should actually approach raising capital? Jerry?
Do you want me to jump in?
Yeah, either one.
So yeah, I think what's interesting, we sort of looked at data where over the last, call it the COVID years, growth was most rewarded. If you looked at a listed company's valuation, the key thing that explained its valuation was its rate of growth. And now if you do the same analysis, the key thing that explains its valuation is actually what's called the rule of 40. So it's a metric that looks at both growth and profitability. And that's very much reflective, investors are thinking about that as well. So it's no longer just growth at any cost. It's, how efficient is that growth? Or how profitable it is. So if you're, the rule of 40 basically says if you're break even, then you should be growing at least 40% or more. Or if you're burning 40% of your revenue, then you need to be, not growing. And so it's a metric that sort of reflects both. So I think that's probably the key change where, investors are very much honing in on that. And then, metrics underneath that, like burn multiples, are things that, investors are really focusing on, and efficient burn multiples. And then just the quality of the business, as Rajiv talked about, gross margin has always been, critical. and sort of your net revenue retention, which in this market in particular, generating revenue from existing customers and growing sort of the existing customer base is key, I think, and probably easier than trying to win net new customers.
Yeah, Rajiv?
Well, the only thing I would add to that is in terms of, during that COVID high growth period where companies were raising a lot of money, the one significant change we're seeing is, so as an example, if there was a company raising $5 million back then, $5 million now, the 5 million back then would be $1 million for marketing, $1 million for product development, and then 3 million would be this ether number of working capital, which was unexplained. What we're noticing now, that same company that's trying to raise 5 will not raise 5 now. It will raise 2.5 million for product, $1 million for marketing, and 500 for working capital, which seems much more rational and sensible. So that's automatically having an impact on the valuation because they're raising less money.
Yeah. Yeah, and Jake, you talked through, one Friday we sort of talked about the due diligence process becoming longer. Just want to sort of share your thoughts on that, so I thought that was quite interesting as well.
Yeah, so I think in this environment generally, investors are probably more cautious just with the volatility in the markets. And, in any environment, you always want to under-promise and over-deliver. And I think it's even more important now. So as you go into a raise, you always want to be showing or saying, at the end of May, I should be hitting 2 million of ARR. And then you get to the end of May, writing to the investor saying, hey, we said we're going to hit 2, we actually hit 2.1. And at the end of June, we're going to be at 2.3, writing and saying, hey, we actually hit 2.4. And I think investors in this time, because they are more cautious, they're taking more time to do their work, their analysis. And so you're likely going to have a few months. Well, in a normal environment, it'll take 3 to 6 months to raise. I'd probably add another 2 months in this environment. And so that gives you an opportunity to sort of, under-promise and over-deliver and just build momentum in the raise and having, just to show that delivery to investors to really sort of help get them over the line.
So make sure your numbers are reasonable, the ones that you show.
Make sure they're reasonable and you're confident you can, slightly over deliver rather than the other way around.
Yep. Okay. So I suppose the other thing is, one of the things we get asked is this the new normal? And if it is, then how long is it going to last? We know that things are cyclical, so you guys have been through a number of cycles, I'm assuming. So I think it's just interesting to get your view on, that's what everyone's asking us. Do you speak to VCs? How long do they think this is going to last? What's it going to look like? Do you have sort of any thoughts on that, Rajiv?
If rates go back to 0, we'll go back to a similar environment.
Right.
Who knows if and when that ever happens, but I don't think it's happening in the next 3 to 5 years. So it'll continue to be challenged. If you look at global corporate formation in the last 5 years, it's been very easy to start a business and raise money for a business. It's not going to be hard to start a business. It's going to be very difficult to raise a business. Raise money for a business. So in our view, we think that it's going to be challenging for the next 6 months. It starts to alleviate probably in calendar 24 when public markets will allow new companies to raise capital and become listed. And if that happens, then private markets will somewhat normalize as well.
Do you have anything to add to that one?
No, 100% agree. I think it's very much linked to interest rates. And it doesn't feel like going back to 0% anytime soon. But the good news is after every bust follows a boom. So I guess we're getting closer to a boom. But it's I'd say at least 3 to 5 years away before we're back to maybe the highs we experienced over the last 2 years. But I think in your question, Amanda, the new normal, I think we're just returning to normal. Interest rates at 5 or 6% is a pretty normal state. It's just that it's happened pretty quickly. That's probably caused, a lot of angst, but it's literally returning to a more normalized state. 0% interest rates is definitely abnormal.
Yep.
Amanda, to give people a sense on valuation, back in 2021 and parts of 22, super high growth companies, who cares what their profit was? We're trading 15 to 20 times and sometimes higher. Those companies that are now much more focused on profitability and their growth is tempered are still trading, 10 to 15. So it's compressed, but the super high quality ones have an have a revenue multiple which is high, but they often have an earnings multiple as well, and that's very high. The lower quality companies that had growth and the growth has dropped off and did not have intentions of profitability and are struggling to show it, those multiples that have gone from 7 to 12 times are now 1 to 2 times. So they have compressed the most, and they're the ones that need to prove to the market that they can in fact generate profitability. And that's where a lot of them are struggling still.
Yeah, okay, great. Just one last one for Jerry and Rajiv. I think this is actually one that you raised before. We thought this was a good question, actually, Jerry, back to you. But if investors are being more discerning in this market, what is an investment that is a no-brainer? And the second part to it is, if you're in the middle, how do you move yourself up the top quartile when you have a better chance of getting the raise away? So what's a no-brainer?
Yeah, so I think, again, it's stage dependent, but I think at the early stage, some of the metrics that are, very compelling are an LTV to CAC of 3 times or above. And I saw one of the questions was some specific metrics. So, which means that for every dollar of, cost of acquisition, sales and marketing costs, you're generating $3 of lifetime value, gross margin sort of lifetime value. A burn multiple of 2 times or less, which means that for every $2 of burn, you're generating at least $1 of recurring income, and sort of a less than 12-month payback on your cost of acquisition. So those are probably some metrics to think about where, and probably the other one is net dollar retention. So if that's sort of above 100%, 110, 120%, that's a very strong metric. So your existing customer base net of churn is growing 10 to 20% per annum without adding any new customers. So I think those 4 metrics, you've got a pretty solid, business from a unit economic perspective. And so if you're in the middle of the pack, I think it's sort of focusing on those and trying to move yourself into the zone of having those types of metrics. And I think, it's not a shameless plug for KPMG High Growth Ventures, but I think getting your house in order on the financial side is key, particularly in this market. It's something that we see in our portfolio companies, those that are sort of, have their finger on the pulse, not only have the data, but, the insights and sort of managing their business to it, are in a very different spot to those that don't have their house in order on the finance side. So yeah, it's probably those 2 things. I think try and move your business into the zone of those metrics, which I'd consider strong, and obviously a whole lot more comes into it. Primarily the quality of the team and the founders is probably the first thing, particularly at the early stage. But yeah, I'd say sort of moving yourself into the zone of those metrics and getting your house in order on the finance side. Yeah.
Rajiv, anything to add to that one?
I do. So this is what we look for. This for us would be a no-brainer. 30 to 40% revenue growth, a gross margin of 70% plus, an operating margin 2 to 3 years now, which is somewhere between 25 and 30%, would be extraordinary. We also look at revenue per employee. If you can get to 150,000 revenue per employee, you can cover your employee costs, which is great. We like to see 20 to 30% R&D spend, and we like to see 15 to 20% sales and marketing spend. The other things that I think are qualitative, and to extend on what Jerry said, and again, this is where the KPMG High Growth Digital Ventures team can help people, is around org design, that finance function, and getting that board in place. Those are critical aspects about what they're all the facets that would go into it as an extension of what Jerry said to be a no-brainer business for us.
Actually, just on that, Rajiv, can you just touch on the org design piece? Because you talked about that the other day as well and mentioned some of the roles that you're seeing are being made sort of redundant or they're not being replaced, and why that is. So how has this sort of focus on profitability impacted the org structure for startups?
You know, every organization that raises money is guilty of raising the money, and within a couple of weeks they hire 20 to 30% incremental staff and do an offsite in the Byron Bay hinterland. I mean, both those behaviors are just not great, and it's coming home to roost now. Org design for us is important because inevitably when you grow quickly, you're filling slots that can be redundant even before they're created. So what we like to see is when a team is somewhere between 15 and 20 people, the founders, and if there is a board at the time, sitting down and constructing a design which can scale it from that 15 to 20 to first phase up to 50, and then the second phase is up to 200. So you know what you need to hire for well in advance of hiring. I think a lot of people backfill their hiring, and that's when you get cost overrun.
Yeah, great. All right, we might shift up a bit. I also saw a question about looking at efficient growth. Daniel is sitting there very patiently. He's going to talk to us all about efficient growth, so we will get to it in a second. Sorry, it seems quite segmented, this one, but Leanne, to go over to you. So obviously, as you said, Leanne is the partner we work with probably the most because she delivers our outsourced CFO offering to our startup clients. Just interested to hear your perspective on, how has this shift to profitability impacted the way that you're working with founders?
Yeah, it does. It ties perfectly and flows on exactly what Jerry and Raj were just sort of saying about that profitability efficiency piece. A lot of what we see is a lot of founders come and I've done my projections and here's this spreadsheet and it often has colours and a few lines on it, and it's like, good, but so what? But how is this it's not showing that you're making any profit. It's not showing where your investment spend is. It's just a line of outgoings. That's all this is. And eventually we have some revenue come in. And so how we're working with that is to say, well, hang on a second, stop. And we're all very big on three ways. So your balance sheet, your P&L and your cash. And the big piece in this is cash, cash, cash. Where's the cash? And, Jerry said there a number of times, that efficiency. So what cash are you getting? So what profit are you generating? Where is it going? And what's the outcome from that spend? And is that outcome efficient? And so that's the big piece. And efficient doesn't necessarily mean you as a founder are doing everything. And that then ties into what Raj was just saying about that org design. Is sort of like, well, hang on a second. What do you need to spend to get people to do things efficiently? Or is there other technology that you need to do things efficiently? So we can get an application that will do it at, $200 a month, or we can employ somebody at $200 a month, $200,000 a month, whatever it might be. So it's helping with that efficiency and looking at how the impact of your cash across your business from like your P&L perspective, from your balance sheet, that's in terms of your investment, and then in terms of those projections. And then in terms of those, like your cash flow projections and overall projections, people think, well, again, here's my profit and loss and it shows I made these dollars. Good. Here's my balance sheet and it shows that I've invested X amount in R&D. Good. But then, okay, yes, and then here's another spreadsheet that shows, okay, well, I've got 5 customers. Well, again, what was exactly said, what is your CAC? So in terms of that spend, if you do X, so what are your levers, what are your drivers? If you change this, what does that mean to your CAC? If you do the X and Y, when do your fixed costs actually become variable? And so how can you change those levers? If you invest this, as opposed to everybody talks, this is my CAC, this is my CAC, this is my CAC, but Jerry just said, but hang on a second, but it's easier to get potentially more revenue off existing customers. So what's your cost of growing existing customers versus your cost of getting new customers? And again, that's that efficient piece. So how are you growing? So are you growing new customers or you're growing from existing customers, and what's your spend in terms of doing those sorts of things? Again, levers and drivers, forecasting, what does that mean? What's that doing to your gross margin? What does that mean to Raj? What does that mean for your marketing spend? What does that mean in terms of, well, at this point in time, the revenue I'm getting is only 100,000 per employee, but as we grow in terms of spend and ongoing investment, I'm now getting $160,000 per employee. So it's really looking at your P&L and your balance sheet. That's everything that's happened in the past. Understanding your levers and drivers to what does that mean for my cash for tomorrow and for next week, and how efficient are we being in doing that?
Now, you might have touched on some of the things in the next questions, but I'll go through them anyway, just so we can make sure we've covered it. So what are some of the key factors to consider when thinking about extending cash flow?
Efficiency. Yeah, definitely efficient. And it's, and look, and I do come back and we do like, you got to be efficient and you got to, you know, we're really focused on growing profitably. It doesn't mean not spending money. And, you know, and we spoke about right in the get-go is you might have a significantly higher cash burn rate to get you more cash flow tomorrow, but it's understanding the levers and drivers of your business. If we do accelerate that, is that going to accelerate the revenue, or am I just throwing cash against the wall and hoping that it sticks?
Yeah.
Something that I've seen kind of like some businesses do is kind of like more heavily discount like annual plans to kind of like get, especially on like the SaaS side, to get kind of like that cash flow in the door up front. Leanne, what's kind of like your view on that?
About getting the cash flow up, accelerating to get cash flow up front.
Like specifically in the SaaS space, businesses kind of like more heavily discount on the annual plan side. So we kind of like get that upfront payment rather than kind of like more money, but ultimately every month. So to really kind of like pull forward the revenue effectively.
Yeah, look, everybody's got their own story in that regard. And I always err on the caution with that strategy. And the reason I err on that is that, yes, I appreciate you want to get that cash flow, but you are potentially compromising your business model. And how do you get out of that discounting to get to where you actually want to be? And that can actually cost you to get out. So by the time you've now, yes, I've got that in, I've had to pay the price to change the business model to get to where I want to be, you're no further ahead than when you started in the first place. And again, you're sort of like, well, hang on, somebody may be interested in you, but you're not generating the gross margin that you should be doing. You're not doing this, you're not doing that. If people are starting to look at and you're really interested in you today, all of those things are going to sort of, I'm not so well interested, come back to me later. And they're going to wait till you get out of it. So you actually might find that it's actually longer before you have some serious investment dollars. So I really do err on the caution about that whole discounting initially piece.
So, and again, I think you've touched on this, but just to make sure we've covered it, what are some of the key elements that founders absolutely need to understand in order to demonstrate they know how to run their business efficiently to investors?
Okay.
And that you might also flip that a little bit, Leanne, around.
Yeah.
I think we sort of, you know, often we'll talk about some of the gaps that we're seeing across the board. And even Rajiv and Jerry have mentioned this in separate conversations that often, not speaking on their behalf, but often that the financial models just aren't where they need to be. And I think we often, what we often find is founders telling us that they are where they need to be, and that they're just, it seems to be just an area that that requires some upskilling often.
Absolutely. And I'm going to say nobody's Robinson Crusoe. Look, some founders have a financial background, but typically it's, you know, particularly in this, is like it's more technology and science or whatever. It's not numbers. And what they understand is they understand their product and they're intimately in love with the product, which is great. But understanding your product and being able to talk about your product is not the same as being able to talk about the commercials of your business. Two very, very different things. And then what happens is you turn up to an investor meeting or whatever it might be, and you continue to, like, this is my product and this is my CAC, good. And then you've got nothing else. And you just keep referring like to those things. And if I do this, I can get that. No. And here's my P&L, and here's my balance sheet, and here's my forecast, and here's my cash. And everything is independent of each other. And that is a giveaway straight away. You don't know what you're talking about because they are all interrelated. And so that's part of what we do, is help you to understand that and take it saying, this is how they're related. So when you go and say, okay, this is my CAC. So if I invest this, and you can see this is the investment dollars that we've made here, and that's in your balance sheet, it generates X amount of revenue. That revenue generates this amount of profit. That profit then generates this amount of cash. And then this cash can then be invested to then accelerate growth there. Everything is interrelated, and it's taken through, and they're the commercials of it. And then through talking through that, and again, that comes down to understanding is, by investing these dollars, this will give me a gross margin of this. Yes, my CAC is that, but then my customer retention costs is X, which generates this profit, which generates this cash with this burn under this what it might be. But should you wish to choose to invest $5 million, this is where it's going to be. And again, everything I suppose I'm talking to is really understanding the levers and the drivers and the sensitivity of that within your model. That's really key too. And not understand, like if you turn up to an investor meeting and you don't understand the sensitivity of when you move one of those levers and drivers, again, you don't understand. You understand your product, but you don't understand how to run a business. And if you don't know, and if you can't demonstrate how you know how to run a business, these guys go, nice idea, but.
Rajiv, and comment.
Leanne, can I just share an anecdote just based on what you've just said?
Fire away.
About a year ago, we met a business that was under 2 years old. It was doing around $70,000 of trailing 12 months revenue. They had taken on an independent small advisor, not a KPMG. The Excel sheet was clearly created by the independent advisor. It had 17 worksheets within the Excel file. It had more macros than a bachelor of confusion could ever create. And some of the cells were actually reaching to 4 or 5 of the different worksheets. It was a crock of shit. Right, so it's really important to your point, and I think we can't underemphasize, and Jerry would no doubt concur, it's got to make sense. And management has got to be actively involved in the financing decisions around the modelling. Sometimes it's entirely outsourced, and you get a company that goes from $70,000 of revenue trailing 12 months to $150 million in 3 years from now. Not possible.
Yeah. And I think that's the point too, and that's where it's, and as I say, we're a support function. We support you in terms of you you have your numbers. They're not our numbers. And there's no point turning up a spreadsheet with 17 worksheets. Suddenly, this is really hard work and it makes my brain hurt. So I'll just look at the other one, which just doesn't make my brain hurt so much. And that's our thing too. And look, and the guys went over earlier, some of those key metrics. What we're talking about here, it's my P&L, my balance sheet, my cash flow, here are my forecasts, here are my KPIs, this is how I'm performing, this is where I'm up to, this investment spend is going to do X, there you go. If you can nail those, and the thing is too, if you nail those from the get-go, and people say, oh, I don't have any revenue, so I don't need to do that. No, yes you do. Yes, you do. You start from day one, because all that happens is as you go through pre-seed, A, B, and IPO, all that's happening is you have more transactions and you've got more zeros at the end of your numbers. That's all it is. It's just growing. So if you nail it in the beginning and you put the right governance, the right processes, the right KPI reporting in it initially, it grows with you. You grow with it. You learn it. So when you get down to that final stage, it's just more of the same and you get it. That's the difference.
Yes, and actually just the question came through, which I thought it's quite interesting. How do VCs feel about founders bringing in an investor broker to a meeting to discuss financials? Or is there an expectation that founders must understand the details? So we get asked this a bit, actually.
I think founders need to understand the details. It's critical. And ultimately that's who investors are backing. So yeah, I think it's really important that they are, as Leanne Raj has said, it's ultimately the founders' numbers that they need to understand and have input on and stand behind. So to have an advisor in the room talking through the numbers is a big no-no.
Rajiv, you agree? I'm sure. All right, on that, Daniel, what a patient man you've been.
No worries.
I'm so sorry. obviously the other half of this conversation is about growth, and I'm sure also it's something, growth's obviously something that Rajiv, Jerry, Leanne all will have comments on as well. So hopefully this will be a bit more integrated. But anyway, so founders are under pressure to cut costs, and more often than not, it's the sales and marketing budget we're finding that just seems to be cut. Can you share your views on that, and also just start with what you're seeing in market at the moment from your perspective?
Yeah, for sure. I mean, I can definitely echo what we've heard before around kind of like seeing the shift from growth at all costs towards like more capital efficiency. And I think it's also been a bit of a shift of kind of like trying to really force that growth with just PPC towards kind of like looking to more sustainable channels, whether that's like organic referrals, etc., but also looking towards more bottom of the funnel components. Yeah, so capital efficiency, like it can really take different shapes or forms from my perspective. And what we are seeing is really at the top of the funnel, for example, as I said, like looking at cheaper channels, yeah, reduction of ad spend, really much tighter criteria around return on ad spend, payback periods, as you've already mentioned, rather than just saying like, here's the money, okay, what's actually kind of like the ROI that we're getting out of that money. And in the middle of the funnel, really much more focus on like conversion rates. How good are we actually at activating that traffic, activating those leads, getting free users to paid users, etc. Kind of like moving them to that kind of like customer lifecycle journey, and how can we automate that process? So do we really need kind of like a sales team calling everyone, or can we kind of define somehow like gold prospects versus our bronze prospects, and the bronze ones just go into like an automated funnel, and the gold ones are kind of like being called because we know they're like high potential, high profile, etc. That's kind of like something in the middle of the funnel. And then at the bottom of the funnel, it's really about like average order value, order frequency, minimizing your churn, which has already been mentioned. Yeah, any customer that you don't lose is one less that you have to reacquire. So really kind of like complete shift in like focus and priorities from my perspective. And obviously, I mean, I'm tooting our own horn here a little bit, but product-led growth is kind of like one of the key components of that. Versus kind of like just purely sales. And again, it depends on the industry that you're in. If you're an enterprise, right, you have to have a sales team, you have to like key account managers and stuff like that. But yeah, really focusing on how can the product sell itself? How do we make it as self-service as possible? How do we remove friction? How do we kind of like move that aha moment earlier in the customer journey to kind of like improve conversion rates and these kind of components that are all critical to product-led growth? Yeah, so the key thing that I'm also seeing is that a lot of people are thinking about that stuff now, but haven't really thought about it for the last 2 years or so, yeah, because it was so easy to grow actually. And now what's happening is really they haven't invested into kind of like the right systems, into the right processes, and everything is kind of like a rush. And we need to kind of like get it out of the door now, and it needs to happen right now. So I think it's kind of like a little bit of a good thing as well, because it's forcing that reflection of, hey, am I measuring the right things? Do I have the right metrics? Do I have the right process for like experimentation, etc. in place, which wasn't really a consideration previously?
Yeah, I think that's one of the things that makes it hard to make decisions around what to stay with and what to cut, because if you're early stage, you may not have been collecting the data, but also you may not have enough data to actually work out which channels are going to sort of deliver the most value. So when you're in that situation, what do you do with that? How do you address that?
Yeah, even worse, I think, is kind of like situations where you think you have got the data and you make decisions on that data, but that data is actually wrong, or you're interpreting it incorrectly and stuff like that. And like, for example, I would never make a decision on like where to put my ad spend based on like Google Analytics, especially if you're kind of in the B2B space, because it's just not the right tool for that. Yeah, if you're kind of like thinking about it, and that's again, like I think 99% of businesses are like using Google Analytics to make these types of decisions, but it's actually like super risky, because if you're actually looking under the hood of these kind of like systems and the way that they're kind of like working, they're not going to give you kind of good insight into which channels are like driving quality leads, and you may kind of like make wrong decisions of where to kind of like focus your investment. So for example, getting a bit technical right now, but Google Analytics kind of like look back window is like 90 days, right? So if your sales cycle in the B2B space is longer than 90 days, you know, your kind of like acquisition channel is not going to show up in kind of like reports that's reporting on like bottom of the funnel metric like revenue and stuff like that. Yeah, but then the other thing that you also need to think about, whether you're kind of like B2B or B2C, is when you're looking at GA, everything is kind of like last click, right? So if I want to do an analysis and understand, well, my Google Ads versus my Facebook versus my SEO versus referrals, what's actually the quality of the leads from like an LTV perspective, not only in an aggregate level, but on a per channel level or even per campaign level. Yeah, I can't do that using GA, because GA is going to say like, well, hey, your email campaign that you sent out to these people that contributed a lot of revenue, well, where did I actually get those people from? Where did I get those emails from, etc.? I've lost that kind of like insight, and Google Analytics can tell me where the signups came from, and it can tell me where the revenue came from the email campaign, but it can make kind of like the connection and say, well, these channel drove that many signups, drove that much revenue, drove that much X, Y, and Z, unless you're kind of like in a really simplistic model where you're really, okay, I click on that ad and I buy kind of like something, yeah? So where you're really in like pure play e-commerce, direct response, etc. I click, I buy, done, yeah? And that's kind of like your transaction model. As soon as you've got kind of like more complex customer journeys, you need kind of like more complex tooling. And that's, I think, something that many people don't actually realize. So they're looking at the wrong data, or they're thinking they've got the right data in place, but it's actually not the case. Yeah.
Yeah, and just like when Leanne was saying about finances, you know, making sure it's set up right from the beginning. Some of the stuff you're saying relates very well to how we start to set our business up as well. Yeah. And I think one of the things that we didn't realize was it is really about the systems from the beginning that you choose. And also for us, it was the fact that it's not, you have to we had to customize quite a lot of it. There was quite a lot of work in the setup. Can you just comment on that? If people are thinking about setting up this sort of more digital function for their marketing and sales, do you have any thoughts or recommendations on how they should be thinking about that?
Yeah, 100%. I mean, I think the key thing that I often see is people not really thinking about cost from like a total cost of ownership perspective. And they're like, well, I'm just going to build this syncing solution between our CRM and our backend ourselves or something like that. I've got the engineering capacity, but you could also just spend, I don't know, $500, $800 a month on like a purpose-built software solution that's out there, you know, like just get a reverse ETL solution in place, spend the money and use your engineering capacity to kind of like build your product rather than having to build it. You're paying those people, you're kind of like not doing feature development. You're not kind of like, you have to maintain it. It's going to break, you know, it's not going to be as well supported by your kind of like downstream destinations. If you want to change something, it's kind of like another development cycle, etc. So that kind of like thinking about tooling from like TCO perspective versus this is a pretty high bill that I have to pay to the SaaS provider. I think that's kind of like also something that we're often educating our customers on, where we're saying like, use kind of like your engineering team to build your core value proposition and buy everything else, because there's other people whose core value proposition is it to shuffle data from system A to kind of like system B.
Yeah. Yeah, and you wrote, the reason I actually got in contact with you originally is because of a paper that we wrote, which was on recession-proof growth. Yeah, recession-proof growth. Exactly. Yeah. Can you just share, because that's sort of, when I started to think about a lot of these things as well, can you share some of sort of the key principles of that? Because I remember there was like preventative, something else. They were really good.
I think maybe we need to kind of like condense it a little bit. Or make it more catchy, but basically like there is kind of like a lot of different components to it, and a lot of this has been kind of like captured already in the conversation we've had earlier across everyone. But from my kind of like perspective, one of the key frameworks and concepts is really structured experimentation, right? So really think about what is actually your learning velocity, right? Especially if you're early stage, and not only from like a product market fit perspective in developing the product, but also from a growth perspective. Yeah, I'm sure everyone has read the Lean Startup, right? But the question is like, are you actually applying that to your growth function? Yeah, how are you kind of structuring your growth function? What capabilities do you have in-house? What do you outsource? And how do you document your learnings? Yeah, how do you share it across the team? Do you have the right culture for everyone to be involved in generating ideas to drive growth for the business? So really, what's your process around that? And do you have the right systems in place to measure the results of your experiments as well in a timely manner. So to give you just kind of like rule of thumb, we internally operate in like weekly sprints. Yeah, and for each weekly sprint, we set ourselves kind of like a certain number of experiments that we want to run. Yeah, whether that's kind of like incremental experiments or kind of like radical, I call it like big bang experiments, effectively, that are taking more effort to execute. But you can set yourself that goal, right? You can say, look, this week I want to launch 5, 10, 20 experiments. And again, that can be as easy as just sending out a survey, right? That's kind of like super low friction experiment to try and validate certain product features or ideas that you've got. And now you've got that initial response. You can now go to kind of like stage two, build like a quick mock-up in like Webflow or so, send time traffic on it, see how people are interacting with it, etc. And then you kind of like go to the engineering team, you actually start building it out and stuff like that. Yeah, so that structure behind like validating your ideas and behind not just building something, but building something that's going to drive a known outcome. I think that's kind of like key. And then the other thing I had kind of mentioned already is really focus on bottom of the funnel first, right? So really like revenue, what's kind of like your upsells, cross sells, driving order frequency, retention, right? Retaining customers that you've got, rather than pouring money into like a leaky bucket and always having to kind of like refill that bucket effectively. And then also thinking about stuff like referrals, how do you drive advocacy for your product? Yeah, because if you've got advocates that are going out there that's selling the product for you because it's just so good. Yeah, I personally do that for some of the platforms that we work with, right? I love my segment, full story, high touch, customer IO and stuff like that. That's kind of like platforms where I'm like, have you heard of this? You know, it's amazing. Yeah, and you know, they're like, that's kind of like the ideal scenario that you want to kind of like get into. But then also the other thing that I think is important is really thinking about like variable versus fixed costs, right? So obviously that goes a little bit into like Leanne's area, but my kind of like personal framework or mental model that I'm thinking about like when I'm thinking about de-risking, I always prefer kind of like variable costs, even if my variable costs are kind of like higher over kind of fixed costs, just because it gives me more control of kind of like scaling up and down. Like think about full-time versus contractor, you know, that kind of like thought process. Think about SaaS tooling, building it in-house and having to maintain it versus kind of like just signing up from a subscription. One of the key tools that we love using across clients is Segment, which is like a customer data platform. And what that effectively accomplishes is, it kind of modularizes your entire growth stack, right? So on the one side, you've got your engineering team that emits the events and sends them to the customer data platform. And then the other side, you've got all your data consumers like your HubSpots and CRMs and marketing automation systems and whatnot. And effectively, it means one, marketing can act independently, or growth can act independently of your engineering team, and you don't need to wait kind of like a sprint cycle for like something new to be released so that you can send out a marketing campaign. But you have the data and you can kind of like work around and work with that information that you've got in your systems. And the other thing is, if you want to now switch out HubSpot for Salesforce or Salesforce for kind of like, I don't know, close CRM, you know, you can do that. And it's like that because all the information is already flowing, and ultimately Segment doesn't really care what kind of like the downstream destination is doing with that information. So that's kind of like one of the key things that I really like, that kind of like modularization component. Yeah.
Great. And just conscious of time, actually, I just totally forgot about the time. Rajiv and Jerry, is there anything for your perspective to add from that growth? Just hearing all of that, anything that you're seeing from a growth perspective that's worth talking about, or that you'd like to see? Oh, Jerry, you're on mute.
Yeah, Jerry.
Probably comes back to some of the points we're making before, just around, you know, efficient growth, and you know, to Daniel's point, sometimes you don't have the data, or you're getting the wrong insights from the data, but yeah, I think it's sort of the, you know, efficiency of your growth is really key.
Yeah.
Can I just jump in 2 seconds on that? And actually, I did mean to make a point on that, and Jerry hit the nail on the head with that word he used, insights. that again, like a lot of founders think, well, because I've got to say a bookkeeper and they're processing everything, and here's another spreadsheet with numbers on it. Again, that's data. And so you need to turn that data into information. And that's where it's not necessarily expected that you know it to day one, but you've got to get yourself up that curve and understand what the data is telling you to give you those insights, to give you the information, because it's the information that you're going to be talking to investors about. And they're two very, very different things.
Growth, in our view, growth is tempered. 80% growth a year and a half ago was seen as bad. People wanted 200% growth. What's important is growth is often an outcome. You may want it as an input. If you can generate anything above 40 to 50%, in our opinion, that is wonderful. That's 20 times GDP growth. And if you can consistently do that over a 3 or 4 year period, you will build a very good business.
Okay. So last question for everyone before we finish. What is one actionable insight that you would give to founders today that they can take away to grow efficiently in this market? You might have already covered it, but it's fine to repeat it. I'll start with you again, Rajiv.
So I think people can make a good business, but a good business with bad people over time becomes a bad business. So I want to make the actionable item about people. I would say to people, do not overhire. Your first marker for efficiency should be getting to a revenue per employee of $100,000, because then you can easily cover your staff costs. The worst thing for any business owner and grower is to get rid of staff. So you want to try and be able to cover your staff costs as soon as you can. And a final extension is, I think at relatively early stages, when you have less than 30 or 40 people, have less chiefs of. The only chiefs I think you need are the chief executive officer, the chief financial officer, chief technology officer, and chief product and revenue officer. You do not need a chief of socials. You do not need a chief of people, and you do not need a chief of community.
Love it. Jerry?
What about a chief vibe officer? No, so I think probably one actionable takeaway in this world where resources are more limited and harder to come by is just something I talked about before, but almost reorientating your limited sales and customer success team to focus on existing customers. And Daniel talked about cross-sell, upsell, and retention. I think that in this market is really important and should be more efficient than looking externally for net new customers. But having said that, that's very time-bound advice. It's short-term. You'd want to be reassessing that every 3 months. You don't want to be just completely focused internally, not growing net new customers, and then have in 6 months, 12 months, have a massive hole in your pipeline because you haven't done any outbound prospecting. But I think in the short term, in the 3 to 6 months, where net new customers will be harder, sales cycles will be longer, you might find that your limited resources are better spent on expanding existing customers and reducing your churn.
Great, thank you. Leanne?
Ask for help. You can't be the CEO, CFO, CIO. You can't be all of that. Ask for help. And you can't get yourself up the learning curve of financial competency by doing it at the kitchen table in front of Netflix on a Saturday night when you think you've got time. It's really important. Invest in yourself and give yourself, invest in that time to get yourself up that curve. It will serve you well today, and more so you'll get it paid back to you 10 times over down the track and in your conversations. Learn about your business, not just your product.
Excellent. And finally, Daniel.
Yeah, I mean, for me, it's really about that underlying structured experimentation. Yeah, so have a process, for ideation, have a process for prioritization, have a process for defining the metrics, and don't change the metrics after you're running your experiments, because you'd like to be successful with your experiments, right? That's another thing. So structure, process, systems. Yeah. So that's kind of like the key thing for me. Get those right, and the rest will kind of like come out of it. Yeah.
Fantastic. Look at that, right on 1 o'clock. My God, that's efficiency. Thank you very much to the panelists. Thank you everyone for listening. Have a great rest of your day. See you. Thank you.
Thank you,
Thanks,
everybody.
guys. Thanks
Yeah.
a lot.